if you can't look at other data or economic data and understand macroeconomic factors, you're really fucked. You shouldn't be a stock investor. I know that. You can make money in real estate, kinda, but you're going to be very limited in stocks. If you can't read financial statements, you're Attention all winners. I'm Derek Moneyberg, and I'm inviting you to a live web training hosted by me and Brandon Carter this Sunday, May 7th. We're going to discuss the strategies we're implementing today to grow our online businesses and our investment portfolios. These are the tactics that have helped our clients and ourselves make a lot more money, earn a lot more freedom, travel the world, and do all the things you're excited to do in life. When you implement these fundamental rules of success, they're going to help you too. Those insights are just the beginning. This training also marks the 1-year anniversary of my incredibly successful digital program, The 10 Commandments of Wealth. This program has already sparked tens of millions of dollars in commerce around the world. We want you to take part in that success as well. When you join us live on Sunday's call, you get an exclusive offer to get inside the program. Live attendees will get the best possible deal to get inside. We've never made the price lower. We're never going to do it in the future. The bonus package is never going to be any sweeter than this. Don't miss this. Get on that call, ask your intelligent questions live, and seize this opportunity. Click that link and get registered for this session before seats fill to capacity. We're excited to meet you live this Sunday, May 7th. Click the link. You say it's important to understand accounting so we can take advantage, for example, with research and development expensed from earnings. We could have a good business with low earnings and poor PE ratio when an owner-operator reinvests profits back into the business. What do you think about investing in these small-cap companies that have a sustainable competitive advantage, sales growth, strong return on equity, but low earnings, and poor PE? Are there other strategies or scenarios where value is hidden in the fundamentals? Well, I mean, there's a whole business strategy of buying, individual companies, like, small businesses, like from the individual owners. So think like, dental practices or, a number of things, addiction clinics, dental practices, hormone replacement therapy type clinics. There's all sorts of things like this, or, hair salons, whatever. There's all sorts of things where people buy up small businesses that are pretty, they're decent little businesses, and then, have a decent book of clients, but maybe aren't run optimally efficiently. And then they, consolidate them together, put in more smooth and coherent systems. So, they could be managed a bit more remotely. And then they sell them to private equity companies for a much higher PE ratio. So, maybe you pay 2.5 or 4x earnings for something. Maybe you sell it for 8 or 10x or more, depending on the type of company it is. But, if you can buy something for 3x and sell it for 9x, that's a hell of a return, And then, of course, there's some debt involved in that. So you'd have some lender financing or seller financing or bank financing involved. So your cash-on-cash returns would be tremendously more than 3x. So, if you can do that, there's a lot of money. Now, it's not easy to do that. So every asshole, as soon as they hear what private equity means, then they think, I could do that. So, well, okay, but there's a lot of other companies that are bidding up assets. They bid up the asset prices to silly numbers sometimes. And there's a lot of competition in those areas. So there's opportunity, but there's also the prices are high, there's competition. But if you can do it well, there's a lot of money. Now, as far as accounting, if you can't read financial statements, I don't know. How do we compare that? That'd be like, imagine if you moved to a foreign country and you were going to be a math teacher there, but you don't speak the local language. You don't speak the language that people can communicate with. So, like, you might know a lot of other things in the business. You might know math, but you're not going to be very good at fucking teaching it. In Brazil, if you can't speak Portuguese, you're not going to be a very great math teacher in Japan if you can't speak Japanese. So, in business, is like, you might know some other things about business, but if you can't read the financial statements and you're not going to be respected by other people who can. Nobody's going to pay attention to you if you can't read the financial statement. It's actually worse than I'm saying. It's worse than, that's not the best example I just gave, because it's actually much worse. Because that presumes that you understand the math and you're just having a hard time communicating it. But this is actually much worse than that, where if you can't understand what the financial statements mean, then you don't know if it's a good business or not. If you can't read basic publicly traded companies quarterly and annual statements, and then if you can't look at other data or economic data and understand macroeconomic factors, you're really fucked. You shouldn't be a stock investor. I know that. You can make money in real estate, kinda, but you're going to be very limited in stocks. If you can't read financial statements, you're fucked. And in real estate too, you're going to be fucked, by the way. It's just less fucked than, instead of being bankrupt, you'll just make tiny returns. You make tiny returns instead of huge returns because you couldn't understand the financial statements. In the stock market, you'll just be bankrupt instead. So, you have to understand basic accounting. I mean, it don't have to be crazy complex. It can be, basic financial accounting, managerial accounting, things they teach at a community college. I go through these in depth in the Moneyberg mentoring course. I go through them in a bit more detail separately in the 10 Commandments course. So those are the type of things that you'd need to know, that you can avoid the academic stuff and focus on, the key variables that would help you make a good decision in business, in your own, investments. So you got to go through that in 10 Commandments and also in the Moneyberg mentoring course. And that would put you, that put you in a pretty good spot, that you'd have a good understanding. And I look forward to seeing you, Mike. I look forward to seeing you in September at our conference. I look forward to seeing you tonight on the mastermind call. And, we could expand a little more on this topic then if you really want to, but you have to understand, fundamentals of accounting. You have to. Mr. Lawrence says, good afternoon, Derek and team. The more I look into REITs compared to single-family homes and owning investment property, the more appealing the REITs look. That's what I think too, honestly. I've done both. I don't own any single-family rentals anymore. I do have, many millions of dollars in REITs. He continues on, says, I'm looking at different REITs other than commercial or residential. Are there manufacturing and industrial REITs that are performing as well as Class A mall REITs that are on your radar? What information would you advise looking at on annual reports that might differ from traditional companies' 10K? There's REITs in everything, dude. Like there's REITs that own cell phone towers. There's REITs that own like server warehouses, like warehouse buildings that are air conditioned for computer servers. So there's REITs for all sorts of different things. It's very diversified. So do I know all of them? No, I don't. I don't. There's more than 8,000 stocks out there on the main indexes, and I don't know. Do I know all of them? Hell no. Does Warren Buffett know all of them? No, of course not. There's only a few that he's interested in. He's got to move so much money that he can't, I don't know if there's 100 companies in the whole world that he's really interested in. So, because most of them are too small. So no, I don't know all of them. Do your research. I give you the tools to do the research to try to understand things pretty well yourself. I like those mall REITs. I don't think they're going to perform worth a shit in the short term. But if they do, I don't want to miss the movement. And even Macerich was up. The Macerich got smacked around a lot in the past month. But if you bought it last week, you're already up over 10% in a few days, in a week. So 10% in a week is great. If you get 10% a year compounded, it's not bad. If you get 10% in a week, it's amazing. If you use some options contracts, you'd be up huge. So there's a lot of opportunity there. I think those stocks are going to do very good, in my opinion. I'm not telling you to buy them. If you don't understand them, you should definitely not buy them. I don't tell anybody what to spend their money on. So if you don't understand it, definitely don't buy it. But I think when interest rates go down, which I anticipate they will next year, when interest rates go down, those stocks are going to soar. And I like to buy things when it's on sale, and I don't mind sitting on something for a year or two or more. I don't mind sitting on it for several years. So, it's the best way that I found to predict the future is find things that are very out of favor that you can imagine. Like, well, are women going to want to go shopping in the future? Where's she going to go shopping? Well, she'd probably like to go to a place that's clean, that there's other pretty women. That sounds like a Class A mall. So, Derek, what about online sales? Yeah, dick face, that's fine. Online sales, the internet's 20% of retail sales now. And brick and mortar is still over 80%. And they've been saying for more than half of my life, they've been saying since the 90s, that, the end of retail, the end of brick and mortar. Guess what? 20-something years later, that's 1997 or so, 97, 98, 99. The whole dot-com bubble was based on these crazy valuations that made no fucking sense, and most of those companies went out of business. So that's 25 years ago, and 25 years later, they've been saying it for the whole 25 years, and 25 years later, brick and mortar is 20%, less than 20. Excuse me, online is less than 20%, and brick and mortar is still over 80%. So I don't believe that shit. I still don't believe it. Part of the ritual is to go to the store and pick the shit out with her friends. Part of luxury goods, when I buy my 12th luxury watch, I don't buy it on the internet without knowing what it is. I got to go to the store. I got to look at it. I got to feel it. I want to see it on my wrist. So I'm probably going to need an extra link with this because I got big ass wrists. So that's part of what it is, man. So that's going to happen at a Class A mall. And if that's where fancy people with money are, then the stores are going to pay the rents. And if the stores pay premium rents, then the mall can give me fat ass returns because a REIT is obligated to do so to maintain their REIT structure. So I like it. I feel very comfortable with it. If you don't like it, don't buy them. No problem. But I like them. So I prefer owning real estate through the REITs more than. And look, if you're starting off and you don't have a lot of money, that's fine. Go buy whatever investment class suits you best for who you are and what you want to do. That's great. But I like that I don't have to deal with people. I'm buying those fucking assets for less than it would cost me to build them. So when those things are on sale, you can buy it for less than it would cost to build. I don't have to deal with the construction. I don't have to deal with the finance structure. I don't have to deal with humans. It comes with a free management company that's probably better managers than I could be personally with those assets. So I don't know. I think it's great. I think they're fantastic. And if you're starting off and you need to make some money and you want a higher leverage, then you could buy individual properties. If you already had a nice chunk of money, I love REITs. Or if you don't have a lot of money but you're interested in REITs, you could look at options contracts around the REITs, or you could look at a margin account that would allow you to have more leverage and less equity but more leverage. And that's a double-edged sword. When things go your way, they really go your way. And when things go against you, they can really go against you. So that's a double-edged sword. But there's still ways to find leverage with REITs, either through options contracts or a margin account with your broker. Mr. Bryan, and good comment, Matthew, and thank you for your nice words and good comment, good question. Brian says, I was wondering if you go over some of the rationale behind why REITs distribute their earnings in dividends, any advantages of why that is particularly good strategy in a high inflation environment. Yep, I'll do it for you. So to maintain their status as a REIT, real estate investment trust, they're obligated to distribute 90% of earnings to their shareholders. So 90% of profits have to go back to the shareholders. That's just part of the tax rules around it. So if you want to operate a REIT, a real estate investment trust, you must return 90% of earnings to the shareholders. So it's not considered a dividend; it's considered a shareholder distribution, and because of that, you don't get taxed like a C corporation. You get taxed like a REIT. So you have single taxation instead of double taxation, where most publicly traded companies, the company gets taxed at the C Corp level, so they pay corporate taxes, and then if they give you a distribution from there, in the form of a dividend, then you pay capital gains taxes on that. So you have double taxation structure. So the REIT skips that, and you have a single taxation structure. But that also means that your distributions from the REIT, you pay taxes on at ordinary income level. Not much more to say about it. So, single taxation instead of double taxation. So more earnings go back to the shareholders, but they're not allowed to keep the money. Now, obviously, they can do repairs to the properties, they can buy new properties, they can do a lot of things. But if they didn't spend the money, in renovations, in repairs, upgrades, new investments, etc., if they're declaring it as a profit, they have to distribute 90% of that to shareholders. And they do that in the form of those distributions that sometimes me or other people misspeak and call it a dividend. It's not really a dividend. It's a shareholder distribution. And you pay ordinary income tax, not capital gains tax, because it's only being taxed once instead of twice. So I hope that answers your question well. Regarding the high inflationary environment, well, that's just what a REIT is. So they're still in the high inflation environment. They could still choose to pay down debt with the money. They could choose to buy more properties and take advantage of the high inflation. There's a lot of things they can do. So there's a lot of managerial discretion. They can spend the money a lot of ways before they declare a profit or a distribution. But, if they didn't spend the money on something else, then it's declared as a profit, then they have to distribute at least 90% of it back to shareholders.